Jim Houghton, partner at Waypoint Partners, and Bob Sheard, founding partner of FreshBritain. Welcome, gentlemen.
Yeah. We were separated at birth. I was the first one out of the womb. I hope you're all looking up and thinking, that old guy's pulled off double denim. But you're probably thinking, is that what private equity looks right now? Is it that bad? The answer is, yeah, it is. I'm up here, been asked to come and talk about 3 questions, which is where is the money going, why is it going there, and what's the impact on brands. I'm not actually private equity, I'm brands. I've been doing this for about 25 years, designed over 250 brands from Levi's to the LVMH group, Nike to New Balance, and during that time worked with many private equity funds from El Capitan to Generation Growth Equity in the US, from Vitruvian over here to Living Bridge. So we've done we interfaced with 10 different private equity funds. But in answer to those questions, I'm trying to flick it on for you. There you go. In answer to those questions, I can't answer them. They're very simple questions. Where's the money going? Why is it going there? And what's the implication for brands? I can help with the last one, but I can't necessarily help with the first 2. So I asked a couple of friends, 4. I asked some friends in North America, Venn Growth Capital, they're a consumer-based fund, ex-McKinsey guys, headquartered out of Toronto. I asked a fund called Turmeric in Singapore, that's chaired by Ravi Thakran, who used to be the chairman of Louis Vuitton in Asia and the chairman of El Capitan Asia, which was the biggest fund out there. I asked EVCP, whose founder is a guy called Marcello, who used to be the CEO of Louis Vuitton, now major shareholder in Bodji. And then over here, I asked Black Rose, who used to be Living Bridge and JP Morgan. So they've got a pretty decent insight into what's going on. Apart from being scruffy, I'm also dyslexic, so everything's a little bit visual, and I'll just have to run around the slide, so forgive me for that. So basically, when I asked the first guy, Black Rose, the basic principle about what's going on right now is he said, look, there's basically the main acquisitions of distressed assets, things that aren't going quite right but have a historical history of quality, and just really hot deals, unicorns, basically. It's the middle that's getting squeezed. Basically, if you're not getting 50% year-on-year growth, then it's just time to sit tight and get fit. And the big trend overall is that it's a race to profit. It's kind of when you can think about it, it's obvious, isn't it? If the macroeconomics in the world are lower consumer spending, then it's not going to be a race to turnover, it's going to be a race to what profit we can get out of the turnover we already have. So that's a sort of synopsis of the UK. The next one was Europe. More or less the same picture. Far fewer deals because the valuations are low. So if the valuations are low, brand owners aren't going to go to market. There's very low consumer spending, which is what's driving those, killing those valuations. So it's just making people hang on. Where there is transacting, it's where it's a great brand with a pristine trajectory and with huge potential for margin expansion. Those are the ones that will transact. The rest are just going to wait and sit it out. The next one I asked was in Asia. Now, Asia is experiencing headwinds like the rest of us, but they do have explosive consumer growth. So there they have higher interest rates, high inflation, feeding off the macroeconomic slowdown. The money is there, though. It's going into sustainable profit. It's going where there's a bottom line focus. It's going where there is clear brand equity and a clear pathway to value creation. The brand multiples are being enhanced by those companies with financial discipline and that are cash generative. But again, in Asia, as in the UK and in Europe, it's a pathway to profit. It's profit over revenue growth. So as brand designers in the room, we've got to help our clients and help our brands grow profits. And how do we design the brand to do that? Next, it was a bit more brutal. It was North America. They said it's unreservedly brutal, meaning that many private equity funds are just triple downing on their existing assets, which is probably not much fun if you're an asset, but there's a lot of sidelines sitting. There's a lot of internal focus and internal redesign where people are dealing with the global supply chain issues. They're looking at high interest rates, the macroeconomic challenges, softening of demand, and model disruption. Where the money is going is to those brands that are seen as sector disruptors. You have to basically be industry leading, you have to be profitable, and you have to have category disrupting profit. You have to be all three at the moment to transact in North America. So where that means, if we aggregate that globally, it means the middle's being squeezed. It means that the priority markets are not the UK, not even North America. Europe is still staying still. It's Asia. The reason it's Asia is that by 2040, 60% of the world's disposable income is going to be spent there by 3.5 billion middle-class Asians. That's half of today's population. And that's about 33 trillion US dollars spent on brands. The issue with Asia is it's 49, 50 countries, it's 2,000 languages, and it's 20 religions. So to unlock that key, you need boots on the ground. It means that we're starting to look at acquisitions that are digital over physical, they're AI enabled, and they're all driven off profit growth. Basically, it's either distressed assets or it's unicorns. So the big question that comes up, which is, what's the impact on brands if that's where the money is going? If the money is going to profit, we have to work out and figure out how do you design a brand to generate more profit. Which is the next slide, please. So basically, when you're looking at designing a brand, sorry, the previous one, is we've got three areas to help generate growth. First of all is designing positioning to generate turnover. That's when you get the positioning right, make sure it's very clear, even if it's polarizing, that's okay. More people will come to you because they understand you. Then it's about generating profits, which is about being addictive. If you're addictive, you create an episodic and serial relationship with the consumer. They move through your core products onto non-core products, and then you generate value through purpose. It's about designing digital transformation over physical transformation. Forget about redesigning the logo, because you're on the clock and you won't get the dividends from a logo redesign in the time your private equity fund needs to transact. It's about looking at building awareness, meaning and difference, geographic growth over demographic growth, and you're in the emotions business. It's about designing emotion into your brand rather than rationality. So emotional superiority over functional superiority, and it's knowing that you're in the beliefs business, not the facts business. Facts make people think, beliefs make people behave, and it's behavior you want to change so that your brand becomes more addictive. How you do that, generating profit growth designed through brand, is you need an addictive personality. It means you have to understand as brand designers the emotional effect you're trying to design. What's the best narrator to deliver that emotional effect? That designs the addictive catharsis that keeps people with you. You have to understand the time, ritual, and place that you own in the life of the consumer. That's addictive. Have rational values that are designed to generate addiction to a need, emotional values that are designed to generate addiction to want, and finally, you have to build charisma into your brand. Charisma is like a charismatic person. It's someone who stands up and stands out for something. So you have to understand what brands stand against. We all need dark sides in our brands. If you ask anyone in this room their favourite film character, they're not going to say Mary Poppins, because we like a bit of dark side. We need the dark to show the light, so we need to know what brands stand for and what brands stand against. And when you pull all those things together, you're more likely to have an addictive brand that will generate more profit, because the people will stay with you and they'll move through your products in an episodic and serial way. The proof of that is Rafa, which was addictive. It transacted for times 20 on a multiple. So if you can get your storytelling, get something addictive around your brand. Their addiction was pain, the glory of suffering, and that's what helped them transact at 20. So hopefully that gives you some indication of the fact there's not much money out there, but where the money that is out there is going, why it's going there, and what brands can do about it. So I'll now hand over to my twin, Jim.
Thanks, Bob. First thing to say probably is that I don't think I know any agencies that are doing 50% growth anywhere, I mean, in any territory. I think the other thing to say is if agencies exist to serve brands, then what I've got to say about agencies naturally is informed by what's going on in the brand world, except that probably agencies will, because they follow and support brands, they tend to lag rather than to lead. So I'm not seeing, and I'm directly involved in private equity investment, I'm not seeing people chasing after Asia, for example, in the agency world. The dynamic you talked about is just too complicated, it's too bloody hard, it's too fragmented, so just avoid. So for one other thing I must follow up on as well, because it's really important for my setup, most private equity funds in the agency world are 10-year funds. So hold on to that thought as I explain to you the private equity dynamic, because while it says that money is difficult to deploy right now because the economy is tough all around the world, private equity firms are built on multiple different funds. If you don't invest a fund and you don't realise the assets in the fund, you don't get to raise a new fund and you lose your job. So the private equity world has this lovely, charming description. It's like they talk about assets, and can agencies really be assets when they're people and intellectual property? Dry powder is this other kind of topic that gets talked about a lot. There is a massive amount of money that's pent up in the private equity world that doesn't have anywhere to go right now, that are a really systemic problem for that industry. But to make sense of this, I need to contrast public ownership versus PE ownership, which I'll try and do when I can get my pad to work, which hopefully it will do. If you think about the public ownership model, and probably the best examples of that, WPP, everyone knows really well. I'm probably sure there's some WPP agency representatives in here today. Publicis, Omnicom, maybe Omnicom to a slightly lesser degree. Think about those firms effectively as giant hedge funds. They're big global funds, but yes, they happen to be invested in marketing as a discipline and related technologies, but kind of they're there as investor vehicles, global hedging against different economic and social situations. What do hedge funds do? They support university endowments, pension funds. So what's important to the public company ownership model is consistency of dividends, like quarterly dividends, which means you've got a big back office, there's no surprises to shareholders, it's a constant need for cash yield from those investments. That's that model. The private equity model is entirely different. It only cares about, and I'm simplifying slightly of course, only cares about the entry point and the exit point. What you do in the middle, frankly, no one cares about. I need to buy as cheap as I can, I need to sell for as high as I can. And what I'm constantly therefore thinking about is where's my opportunity to buy the broken asset, the potential future unicorn, and what are the market dynamics that are likely to create that growth in a short period of time. So if I use a real simple mathematical example, agencies in the UK typically selling at 2 or 3 million of profits. I buy a business at 8 times profits, cost me 24 million quid, 4 years time, it's doing 5 million of profits, sell it at 10 times, and I've made 50 million. So I've kind of doubled my money. That's kind of basic private equity engineering. But the timeline is really, really important. Year one, I'm starting to think about, well, here's a plan I've signed up with this business, and just solidifying the plan, making sure everything's there. Year two, I've really got to action the plan. So it might be buying other businesses, it might be moving into other markets, but I've got to make things happen quickly. Year three is consolidate. And if I'm in a 10-year fund, basically I've probably got 4 years to have bought that business, do all the stuff I want to do with it, and get out the other side. So that final year is probably that's just spent selling the agency. So really, really short time periods where a lot of stuff has to happen so that you can significantly increase profits and significantly increase multiple. So completely the opposite business model to the public markets, where you don't really have license to innovate. You don't really have license to invest a lot of cash off the balance sheet because it's about cash yield to shareholders, so they're completely contrasting. And working in those businesses feels, and I've done both, feels like radically different. There's literally no point of comparison. So what are the PE investors looking for? Slightly contrasting the sort of brand world, because agencies are intellectual capital, and I'm thinking about value as a function of profits and multiple. On the profit side, I want to be investing in companies that can expand into different markets, either overseas or different markets in their own territory, new capabilities, new clients, superstar hires, technology. AI is not a thing anymore in this. AI is just a hygiene thing. If you don't have an answer, you're kind of dead. There isn't a value for a company that doesn't have a view and a response to that. And driving multiples about scale, effectively. Scale, differentiation, and scarcity. Again, that unicorn analogy. So what does that mean in terms of where the market is right now? And I've got a mind that my clock is flashing, saying, Bob used up too much time. Cheers, Bob. We track 7 different verticals within the overall sort of marketing services industry globally. And across all of those businesses, where we try and track the most sort of influential players that are either biggest or they're most innovative, 40% are private globally. So entirely private, owner-managed businesses, probably pretty small, local generally. 34% public companies, and 26% are owned by private equity. So, on the face of it, a pretty small influence in the market overall. But where it breaks down is really interesting. About 40% of the most influential research, insights, and data businesses are private equity backed. About 38% of the healthcare comms industry, similar thing. And social and influencer, surprise, surprise, fragmented markets, super high growth, lots of experimentation. That's about 36% private equity owned by volume. And so what you'll expect to see probably in that research and insight space, there's a lot of investment in the last couple of years. Probably nothing too significant happens for the next 2 years if you assume like a normal 4-year investment period. Healthcare is really different. I expect half of the world's most influential healthcare comms businesses probably change ownership in the next 12 months. So they're all in a sale mode. So whereas the research and insights businesses, they're in build, they're in acquire, consolidate, grow. That healthcare comms space is going to be focusing on exit. And then social and influencer, within the next 18 months, you'll see 9 of the top 14 probably also change hands. So they're starting to get to a place where explosive growth is now into sort of consolidate mode. And that is going to be really influential in terms of how the market shakes out. So I'll wrap up here, but where does that leave us? Interest rates kind of stable going down. Cost of acquisitions, cost of investments really important to private equity investors. So that's a neutral background. Confidence, not good, but it's stable. That's something you can work with, and tons of this dry powder. So 2023 was an absolutely dead year for proper investing, with a couple of notable exceptions. Typically, you get a strong bounce pretty quick. By the end of 2024, I'd imagine that market's at full tilt again. So interesting how the brand world is pointing us, because I think from an agency perspective, PE in the next 12 months starts to get really hot again. But if the brand markets that those agencies are serving are kind of cooling off or moving more to Asia, that could really stress that model. So who knows? Thanks.